Hello, folks. It's Shooter. Hey, we're going to do a little quick special report on the U.S. credit downgrade. Drilled down just a little bit here. Of course, at the end of the presentation, please do review our disclosures. Now, the last time that we had a U.S. credit downgrade was August 5th, 2011. Now, we were already in a drawdown. Almost looks like the market knew we were in this because of how we had this cascade. Now, here's the 5th where it came in. So we really didn't go too much further than where we were. And then we didn't find a bottom till October. Now, that little flat right there is really what concerns me coming behind this. I think it's generous measuring our fibs from the prior low. Generous, back to 2009, coming off of the Great Recession there. It's ironic that it was this long of a period of time before we had the downgrade and that we are in market. So I'm going to go on that premise, but I'm going to come in. I'm going to say there's two fib tools I'm going to throw up here because I want to measure the prior leg and the entire wave one. So I want to measure the intermediate wave with a little different look. So based on that leg, once the news hit, we were at 382. So we doubled our drawdown basically from there. So we had a fairly shallow drawdown. And from the entire leg, we only really went 382 back from the entire move. So let's progress to today and take a look where we are. So we're in wave 3. So now, using that assumption that our credit drawdown will give us a similar number, we would be looking at about a minimum of 438 on the S&P. And then we would be looking at October. Let me lock that in place. So this is our time marker from the prior credit rating downgrade. Now, of course, we're not seeing 382. What that essentially is going to do is it's going to push down this 4, which was going to be broad anyways, this intermediate wave, if I can get it to click on it. So that would push us down to here, which, is out of as long as we don't break below this intermediate wave 2 here, I don't think we have any kind of catastrophe. If that breaks, though, so that 431.19, then it opens up the speed line, a back test of that 419. I don't think it's that we're in a different environment, I think, than where we were coming off the Great Recession. And because the crisis was ending, and the crisis was also consolidated to single-family residences, majority of it. So just taking the skew of where we are with commercial real estate, retail, office space as an example, we could clearly have some downside here. This is one of the reasons, and honestly, I didn't even think about a credit downgrade. Wasn't even on my radar. But that's sort of my thought here. So, we want to look for some of our weak sisters. And I'm going to refer to Kirk. Hey, what are some names here who are going to come off or came off the last time we had a credit downgrade? You're the macro micro guy. Give us some ideas here. I like American Airlines or Delta. I have some decent downside here. Market gets soft, this could get weak pretty quick. So we could target $20 from here. Count supports that move. One thing I don't like here is we sort of have a mound on the daily, which would indicate maybe that we're going to have another one. So we've got a little divergence here. I think I'd be trimming a little bit more here. So, we're right at resistance. So we've got an intermediate wave 3 that suggests we're going to come down and put in a $10, So we got a decent top. I sort of like, I don't want to go too deep though. Looking at maybe right at the money, 45 puts. I think it's worth a shot. Where you're wrong. We get above this 52, I would cover. Or plan to scale in case we back test this. So, my optimum, we get a label up here, just looking where our off numbers are, so 47.50, plan to scale at those numbers, maybe again at 49. So we get up there, so do maybe a 45, a 46 here put, and a 48 put, just spread it out a little bit, October through January. I would think this would weigh, this is sort of a dynamic shift, I believe. Now, I'm not 100% sure that we're going to have this kind of rotation to the downside from a credit rating downgrade. But, my inclination looking at the history of the S&P, reviewing that, we were in a much different environment in 2011. We were coming off of a significant flush. Historic lows basically had clear divergence at the base. We had some clear divergence up here at this top, so that was toppy. Coming back to today, we have some clear divergence here. We came off this much more defined flush in 2020, sort of fast and sweet. So, not as clean of a bottom, but it's there. For the purposes of a bounce, I'd rather have a drawdown like this. So we have a confirmed high here prior to that. and then a divergent high. So this is like 1, this is like 2. And we came off significantly. I'm just talking aloud as I'm looking at this completely different environment than 2011. We are much more euphoric here. We'll have to wait and see exactly how we do come off tomorrow. But, then, think about Delta. And when I come up with some more names, I'll share them in the room. But, history tells us that U.S. Treasuries are required to take a haircut when they're presenting collateral in the markets, specifically oil and gas, commodities, even import and export. So I would suspect that we have some cost inflation that gets reinvigorated there as a result of this, just because of those increased costs. I don't think it's like 1 or 5%, maybe 0.75% or something to that effect. But to some degree, we're going to have that kind of result. But that's what I have today, folks. Great trading. Until next time.